as well, up about 2.5%. All right, we have our market master of the day, Ajay Srivastava, the CEO of Dimensions Corporate, joining in now. Ajay, happy Diwali to you. It's been a good somewhat.
Thank you. Good morning.
At least the start has been pretty firm. How are you feeling about the new year, and what is the expectation as we move along?
Well, I think it was good last year. Nobody can complain about the last year, and I think it's going to be is a good summer this year. But only fact is, depending on from where you look at the whole market, it's like an economy is like a glass half full. You know, some people feel optimistic that, listen, the worst is behind us. Some people can feel pessimistic that the interest rate and inflation will come through and the demand is slowing down. So it just depends upon where you look, from which side of the market you look at it, and you decide whether you want to be optimistic or pessimistic. But one thing we know for sure, and I think that's what the market has taught us, is that the paradigm of this long-term investment concept is gone now. I think you need to learn to be flexible, fast, nimble, and get out of stocks once they reach a good point of valuation from a comfortable point of view. Sticking with them is not a good idea. You know, like say ICICI Bank. 1 year back, it was 850. Today, it was just before the rise happened, it's 850 1 year later. By holding stocks for years and years, I think that's where now the paradigm has changed, that model needs to be tweaked by investors. And you can never have a better opportunity. Equity markets doing well, debt markets doing phenomenally well. What better can you want from an investor standpoint?
ICICI Bank, I thought, is all-time high. I guess you would bother that over the year how much has been the gain. But Ajay, you know, have the banking stocks reached that level? The consistency of the performance is such that it seems to merit, even more backing. You don't think so?
Well, okay, Nada, I would have answered yes categorically. That should be the general answer if the loan growth is 27%. If we knew the RBI policy and if elections were not in FY24. I think, you know, whether we like it or not, higher interest cost which the banks earn and therefore the profit has gone up is an input cost in the economy and the rest of the economy. Now, it depends upon the RBI policy, what they do at the end of the day, that should they just, tighten up the spigot for liquidity and ensure the savers get more money, economic spending goes up. And, so it just depends on where RBI stance is going to be at this point of time. It is very clearly, one answer is very clear. The banks are heading into a bigger risk than they ever thought of, because where the interest rate inflation is, their personal loan portfolio will be at risk in the next 6 months. They cannot be sitting outside because people are not making enough money to battle. You got to meet your ends first before you pay the loans. So the big personal loan problem default is going to come in the next year, whether we like it or not. And you want to price it now, or you can ride the tide up to January and maybe sell off. That's maybe the one way to approach a banking. But certainly you would not be like to be sitting banking from here till June or next October, because the personal loan problem will start to surface. The restructured loan, MSME loan, will start to come out in the next year. The Mudra loan will start to show up into the next year. So you don't want to be sitting there when all these things start to come up. So ride the thing. I agree with you. You may ride the thing, but there will be a point when you need to get off the pedal. Otherwise, point to point, you might be quite disappointed.
Okay, all right. Not a bad time to take some money off the table on the banking names. Ajay, morning. Nigel on this side. Thanks so much for joining.
Good morning, Nigel.
Ajay, I wanted to ask you about the real estate space. The stocks, obviously, they're a far cry from what they were 10 years or so ago. Now you have the rising interest rate scenario that will play out as well. Yes, there's been inventory liquidation, which is good news. The sales numbers are looking pretty good. But what do you do with that space from here on?
See, Nigel, unfortunately, we didn't follow the Hong Kong model, right? So therefore, our market cap of real estate companies has been minuscule compared to what happened in the magic period of Hong Kong or Singapore. And unfortunately, the companies in India have not given returns to shareholders. So it doesn't depend on the market, whether you invested in a DLF or a Prestige or whatever, your rate of returns have not been lucrative. Of course, one can argue that the Macrotech has done good post the IPO. There's no doubt about it. But broadly, in a longer term time frame, for whatever reason, I'm not attributing any motives to it, but somehow or the other, the shareholder never makes return. Each of the promoters are phenomenally rich. The prices of real estate is up, and you see what kind of unaffordable space you guys can afford in Bombay. It looks like a different world altogether, Bombay, Lata and Nigel. But the fact is, how do the shareholders make the return? And I am quite surprised as to why over a period of 2 decades I've seen, we have not made returns, and the price of real estate has gone from where to where at the end of the day. So so I don't know how to interpret this. Maybe somebody else can help me understand why investors don't make money in the real estate companies, but real estate prices keep going up.
We'll have been living in Bombay for decades, and we still don't understand this market. For millennials like us, we were discussing, just when we get ready to afford something, it becomes 50 lakhs more expensive, and then you can't afford it anymore. So Mumbai is a tricky one.
Houses. We've always lived in matchboxes. Okay.
And then you continue to live in pigeonholes. But Ajay, what do you do with some of these spaces that have done well and perhaps are in a structural upcycle, as per what many people believe? Autos, for example, right? I mean, coming out after years of a bear market, do you think the time has come to sort of put fresh money to work in spaces like this?
See, Sonia, as I said, the theory of glass half full is that there is no doubt that Indian economy has gone exactly the way global economy has gone, that the richer have got richer are spending. The poorer, of course, will find it very difficult to buy discretionary items. And I'm not sure whether, it's going to come up in the numbers this quarter, next quarter. One is very clear that the bottom half of whether auto segment or any economic segment is going to struggling for demand at this point of time. So, yes, the upper tier, if you were to buy a Mercedes-Benz India, that would have been a phenomenal stock to buy in, because that's where the growth is. But if you were to buy a Hero Motor, and with 60% of the lower end of the cycle, one would be diffident about it. So, question is, how much of the premium models and premium part of the company is the composition of your sale? If it's going to be high, I think like TVS has shown it's going to be phenomenally well to invest in auto sector. There's no doubt about it. But if you are going into companies with the lower end of the market is the primary focus, I think you'll have trouble. Broadly speaking, India's demand scenario is going to be terrible at the bottom end of the cycle. That goes for every company, I think. It's not just consumer, it goes for every other company. So one is to focus upon the companies where the products are bought by the rich and the upper tier segment. And that's the dilemma as to how do you spend the companies and break them into portions on every sector, whether it is banking, whether it is hotels, but even look at hotels. Only the 5-star hotels are going to make serious amount of money. It's not going to be the budget hotels. They're going to make money. Same is autos. The premium companies will make a lot of money. The bottom guys will struggle. And I think that differentiation, Sonia, will have to be maintained across all sectors. Economy sectors are in trouble. The premium luxury sectors are up for the best time ever.
So what would your advice be then, Ajay? Would you go for what, the Titans kind of stocks? I think that's what you're arguing for, premium products. And what, not equities as an asset class? Put money in fixed income because rates may rise and they give you an opportunity next year?
Lata, you nailed the head. Just hit it in the head. This is the best time to allocate, and you have not done it. A lot of investors have not done it for a while, to go into fixed income. If fixed income will give a better return, it has given better return. If you look at 5-7 years, it's given very good returns when you were in the last cycle of rate increases and you rode the whole capital gain right up to the point where post-COVID happened. I think the same cycle is happening. You will get better returns than equity markets broadly. And we've seen oversubscription of, just now we saw the bond subscribed at 7.9% interest for 25 years. Now, these kind of opportunities come once in a while. So there is a clear case that one needs to pedal down a little bit your equity inclination, no matter how exciting it looks, and move a lot of your money into the fixed income. And that's where they're given money. That's one. Number two is themes like power transmission, investment trusts, etc. Those have given phenomenal returns. So if those products come to the market, newer ones come to the market, they become better. If you look at power investment rates of IndiGrid, etc., they have given a return of almost 60% over the last 2 years. And these are supposed to be quote unquote fixed income products at the end of the day. So, I know it's less exciting. I know it is not the thing which gives you the kicks. But if you want kicks, go skydiving. Equity market perhaps is not the place.
We were asking Samir Arora yesterday whether he had any card parties to attend this Diwali, and he said, no, you know what, the stock market is enough for me. It's a place where I get all my fixes, all my highs. I don't need any more gambling, for the moment at least. But Ajay, pharma used to be a space that you loved way back in the day. I mean, and today, even if you look at it, right, Cipla, Sun Pharma hitting fresh highs. This morning, in fact, Cipla, Sun Pharma, 52-week highs. It's gained already about 15-20% this year. Is there more scope here?
I think there are a lot of companies which are very undervalued in pharma space. Sonia, to be honest, So most companies have been valued at in a single-digit P's kind of stuff, and they will gain tremendously from rupee dollar depreciation. There is no doubt about it. But the caution here is that this flower is like the, I don't know the name of the flower, but which once blossoms once in 20 years, somewhere in Himalayas or something. This pharma is that like flower. You need to catch it at the once in 20-year phenomenon. Yes, I was a great votary for pharma. We made good money, but then it became so sluggish that the return on capital employed became negative. If I look at last 20 years or 15 years, pharma has been the biggest loser in my portfolio in terms of return to capital employed. So, yes, there will be a flower blooming in once in 20 years, but the fact remains that the sector has underperformed. Rupee dollar, now that's where the money is going to come in, is going to give the biggest kick to them, just like it'll give the kick to commodity companies no matter what you do. Pharma, unfortunately, another problem for India is being this, this regulatory action which keeps coming. Now it's become more prominent. It's become in steel, it's come in oil, price cap. Now we saw the electricity regulator saying super power profits, power company profits should be curbed. So, so if you have blockbuster drugs, if you price the drugs higher in India, you can expect government to come in. And that's going to be the biggest risk, if you ask me, to this market is, and why I said you need to get out of the stocks in time, is that moment a stock or industry does extremely well, now the road is open for the government with no guilt to say, I'm going to tax you, and come election year, that propensity will increase. So you need to be careful that sectors which do phenomenally well might have the government's attention to say, listen, you guys made too much money, give me some of it. Otherwise, I think rupee dollar should give a clear 10 to 15% edge to all pharma companies, no matter what the growth rate is.
Okay, all right, Ajay, always good hearing your thoughts. Thanks so much for stopping by, and wishing you all the best for
you too, Nigel. Have a good year.